Good morning. This is Tom Alexander. This is the stock market update, the U.S. stock market update for the week of July 28th, Monday, July 28th. Today is Sunday, the 27th. Hope you're all having a wonderful weekend. And we have a stock market, U.S. stock market, that is in a manic phase of development, vertical to the upside. If you're thinking about shorting this market, I caution you. That's fine. Just have a reason to short it. And right now, there's no reason. The trend is up in all time frames. If you're going to short this market, let the trend change in at least a minor time frame. What is that change? Well, it's when a previous high or low is taken out to the downside. It doesn't have to be any more complicated than that. But if you're shorting this market, you're shorting a market that has incredible upside momentum, regardless of the fact of how extended it is. Notice I didn't use the term overbought because there's no such thing. It is extended, and it's extended by statistical mathematical measures. We'll get into that in just a minute, just a little bit. So let's look at the charts, okay? All right, this is the profile view of the SPX cash. Each profile unit is 1/4 of trade. We just finished an epic up quarter, and we have continued. This is the second quarter. We've continued into the third quarter, trading higher and higher and higher. Now, what is so unusual about, if you don't know anything about market profile, you don't care about market profile, there's still information here that you can probably use, okay? So if you just look at the shape of these structures, each group of letters is a structure. Each group of letters is an auction, okay? And auctions all have typical characteristics. One of those characteristics is that they tend to be regressive around value. There is, in other words, you have an upper extreme, a lower extreme, and then you have a node usually near the mean, not always near the mean of the range. And you get this sort of rough Gaussian looking shape consistently. And if you go back and you look, and this is true across all time frames, this is a chronological constraint of a quarter, but you can look at this on a 5-minute basis. You could look at this hourly, intraday, et cetera, and you're going to see the same shapes. And that's because the auction market process of development is in effect in all degrees of time, all the time, which is what makes it such a robust, valid way to analyze markets and to identify trade opportunity. Okay. So anyway, I digress. So what is different about this view than what we typically see? Well, look how vertical this is. Now, there was a little bit of overlap in here, but if you look at these other quarters, you can see they're typically not nearly as extreme in terms of magnitude of the distribution, the range of the quarter, and you get more price overlap. Okay, these volume nodes. So this is atypical. And what is going to happen, even if we trade higher into the end of the year, you're going to get a more rotational market at some point in time, which means overlap. Now, I have been posting this in the reports and in these videos for the past 2 months. If you want to go back and see the progression of this thing, go to the website. Here it is. Let's see. Let me make sure I'm showing what I think I'm showing. Sometimes I'm not. Yes. Okay. Here's the website, www.alexandertrading.com. Click on weekly update. It's free. You can click on the weekend report. You can do this going back a couple of years or more. I've been posting these YouTube videos for years, but anyway, you can click on the report and you can see the progression of this profile sequence, and it's a great auction market profile lesson itself. So you can click on these reports. You can, in the reports, you can also click on and get a PDF so you can see all the levels and all the other stuff that I run through if you're interested. Okay, so back to the charts. All right, so the SPX, you can see the SPX and NDX all closed in new all-time highs. The New York Composite closed at all-time highs. Let's just look at the individual indices on the bar chart. Now, the levels I have posted here are the most important levels. There's no upside level. All this projection stuff and GAN and LA wave, good luck. There is no quote unquote resistance above the present levels from an auction market perspective. An auction market perspective requires previous trade. And there's no previous trade above Friday's high in the SPX or the NDX. All right, so this is the SPX. Here are the levels to the downside. Now, you can parse it out a little bit finer than this, which is what we do in our live trade room every day, because the process is fractal. So there will be 30-minute levels that will be taken out before daily levels, et cetera. But these are the daily levels that you need to be aware of. Okay, that's the SPX. Where's the NDX? New all-time high, closing high. The NDX is up 41% off the April low. That's normal, right? The Dow, now the Dow is bumping up against a double top here. Here are the levels in the Dow. The Dow has a little balance area, 3-day balance area that's formed. And then the Russell, which is always lagging to one degree or another. And then the New York, did I show the New York composite? No, I don't think I did. New all-time high has just been ripping higher. Now, this is the broadest of the indices we follow. It's all stocks listed on the New York Stock Exchange. What am I leaving out? Equal weight S&P. It's all good. Right at. Did it make a new all-time closing high? It may have. I'm not sure. Very close to it. Yeah, it did. It made a new all-time closing high, not a print high. Very likely to do so. So as you can see, there is broad participation throughout the US stock market, the various indices. That's healthy. Now, another thing that occurred this week that heading into last week, and if you go back and you look at last week's report, I mentioned that there was a small divergence between higher highs in most of the indices and the New York Stock Exchange cumulative advanced decline line. Well, that has been erased. Now, what this means, it does not preclude a retracement. And, we can have this, and we're gonna get a retracement. There's going to be some sort of retracement, 1, 3, 5%. I don't know. And at this point, this market is so manic and panicked to the upside. It's likely to be one of these out of the blue, sharp, how did that happen? Why did that happen? Type of things that you really can't predict. Now, again, on the shorter term charts, if you're day trading on a 5-minute chart or you're day trading on a 30-minute chart, you'll get the signals obviously before you're going to get them on a daily chart. But we're going to get some sort of retracement. Regardless of the depth of that retracement, I don't care if it's 1%, I don't care if it's 10%. The fact that we're making new highs in the NYSE cumulative advanced decline line makes it very, very unlikely that any retracement in here that occurs over the next week or the next 3 months is the final high in this market. Typically, almost always, okay, not somebody can go back and fact check me on this, but I've been trading 40 years. I don't recall a significant top when you did not have more divergences than we're seeing now in terms of price action. Also, divergences between the broader market, cumulative NYSE advanced decline line and the indices. So any decline here of any magnitude is unlikely to be it. Okay, that's really important to realize. You can forget all the talking heads and all the doom and gloom, and just follow price action. Just auction market price action. That's all you need. I'm not saying it's easy, but it is that simple. Okay, let's take a look at some internals here. Okay, landed on VIX. VIX is the lowest it's been since last February, which coincidentally was the last fairly significant top that we've seen. So this is rather interesting. You can make a bullish case here, okay, the other side of the coin, in that the market is calming down. You can see the ranges are getting more narrow. That's a typical bull market signature. But this also can be interpreted as complacency. So how do you trade that? Well, you just have to be aware of it. How do you trade anything? Well, you trade anything through paying attention to the trend of the market in the time frame you're trading. If the market is making higher highs and higher lows in the time frame you're trading, I don't care how overbought they say it is, you've got to be long or flat. So that's your signal to go short. If you start taking out previous higher lows in the time frame you're trading. Okay, let's look at breadth. Breadth is diverging as you would expect. I've been talking about this for months. Again, you can go back and look at previous reports where this is discussed. This is a tool. Now, the red line, for those of you that may be new, by the way, please subscribe. If you have not subscribed, please subscribe. I'm trying to get to 1,000 subscribers this week. I'm like 17 short or something. So I very much appreciate your help in that regard. Okay, so anyway, this is the red line here is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of NYSE advancing issues, and the histogram is breadth. This is sort of a blunt instrument. It can be helpful at times. It's far more helpful in identifying lows than it is highs, as I've been saying for years. I do use it. I do show it. There's a lack of momentum here that eventually will mark at least a short-term top, but uh, you know, these divergences can go on forever. I've shown that many times in the past. Now, a short-term view of breadth. This is the 30-minute chart, and we use this in our live trade room, and it's similar warning about this as using the daily information. This is breadth, NYSE breadth here, and we've had a divergence going on since this particular leg of the rally began way back over here. You can see this was the momentum peak in the current rally, and you've got lower momentum peaks as measured by breadth all the way into Friday. And Friday, you have, I mean, quadruple divergences. Now, how's that going to play out? I don't know. Uh, again, it's it's context. It's not a trading signal. It's not something you can rote trade. It's context. How you trade it, you go if you're a day trader, you can sell it the next time we take out a higher low. Right now, the most recent higher low is here. Now there's likely to be a higher low form between here and there. We go down, have a rally attempt, and take that out. Or you can go down in a 5-minute chart and get in quicker if that's your thing. So guys, I hope you have a wonderful weekend. There will be much more coming. I have a lot of big plans, a lot of stuff coming down the pike. So here's a little hint for you combine traders. I have something cooking. Stay tuned. You guys take care. I'll speak with you soon.